So I'll give you a little background on why I'm here. I'm a Connecticut native, and been here a long time. I went to the Yale School of Management, went to Columbia Engineering, so my background's engineering before that, and then I worked on Wall Street for a while, and then
Excuse me a second.
yeah,
Can people
sure.
hear okay in the
can
back?
You hear me? Yeah.
Yeah, this microphone will go for the whole,
Okay.
whole room.
And then I did kind of what a lot of you did. I bought into a little company that was recycling bottles, cans, paper, and plastic. And when I joined, they had a prototype, and we took it from there till 8 years later. We were doing about $40 million in revenues on a run rate basis, and that was a great success. And we sold it to a public company, and that really taught me a lot about how to finance companies. And we did it mostly with banks and a couple of angel investors. Got me pretty interested in new technology because we had a lot of patented equipment, etc. And then I went from there to a software company. We did the same thing again. Sold it. So it was a touchscreen company. Sold that to NCR, which is another public company. So there's my two experiences running companies. And then after that, I started investing and did what Don was referring to, the angel route. That was back in 2004 when it's kind of new to have angel investing going on in an organized way. We started something called the Angel Investor Forum here in Connecticut, and we're happy that we actually put in place something called the Angel Tax Credit, which I'm going to talk about a little bit tonight. After doing that for a few years, I started investing other people's money, and we did some. I'm pretty interested in environmental companies. You can see with my background that would be a natural outgrowth. So we did a pledge fund with some large family offices to try and put in place some large project finance, some anaerobic digesters. We did some windmills for whoever was doing the vertical windmills. We should talk later. Thank you. So I did a lot of those projects for a couple of years, and then I joined this company, Enhanced Capital. And what Enhanced Capital does is invest large insurance company capital in conjunction with tax credits. And there are tax credits all over the country, which we'll talk a little bit about tonight, both federal and state tax credits. And what we do is we organize both federal and state. Come on in. Hi, good to see you. Two people who just walked in. Arlen, do you want to introduce yourselves? Everyone else introduce themselves.
Okay, if I'm not interrupting.
No, it's all right.
Okay. Well, hi, I'm Arlen Brothers. My company is Brothers Technology LLC. I'm an inventor, mathematician, researcher, and educator. My most recent patent is for a proof of least security encryption system. I'm in the process of developing that now with a developer out in San Carlos. I do have a device that I am currently trying to get to market, and it's an automatic interior mailbox light. It has a C4 magnetic reed switch inside, and when the magnet is in proximity to the reed switch, the light is off. This goes on the door of the mailbox. Obviously, when the door opens, the light comes on. It's inherently weatherproof and wear resistant. The great news is that it's a proven market and a proven moneymaker. This actually made $20 million for somebody else. That's the bad news. So I didn't see a penny of it. But I am looking to partner with anybody who has the knowledge and wherewithal to actually market and manufacture something like this. Not my area of expertise, but there's money to be made here. So that's it. Thank you for the opportunity.
Sure.
Okay.
And the other person who joined, I think it was you, sir, back there.
Tom Lawler. I'm an independent consultant. My company is Custom Consult. I'm based out of Milford. But in my capacity, working with my father-in-law and his startup company, this is now his third, fourth company. He's leveraging technology that's fluorescent technology it's instantaneous microbial detection. So whether it's food and drug manufacturing or pharma or drinking water, rather than the Petri dish, find out 3 or 4 days later, it's online, you can find out immediately. It's an emerging technology that's been around for probably about a dozen years.
Thank you. Okay, so I think we know who everyone in the room is, including me. And what I started to say was that we leverage a lot of tax credits, and that enables us to reach into markets like Connecticut. So our fund is specifically focused. Well, our Connecticut fund is specifically focused on funding Connecticut companies, and we'll talk a little bit more about all the different ways that can happen. But our particular focus is to do a certain percentage in pre-seed companies. That's why I'm here tonight, because I'm interested in your ideas and your companies, and helping you turn those into bigger companies so we can invest in them, because we define pre-seed companies as companies usually with some kind of prototype pretty far developed, and then we like to help get them to market, and a few of you are there. So in case you're wondering what my motivation is here tonight, that's why I'm here. I think the reason ostensibly that I'm here is to teach you what I know in roughly 25, 30 minutes about financing novel companies in Connecticut. So the way I'd like to go proceed, given what I've just heard about who you all are, is I'm going to crank through these slides. You guys should interrupt me absolutely any time that a question comes to mind, okay? So let's just, please feel free to make it as interactive as you would like. Now let's see if I can make this happen. No. Try this, yes. Okay, so what I'd like to talk about is capital resources for commercialization, and this is really just sort of a level-setting concept so you understand my language, what I'm talking about. Investment opportunities fit, trying to make sure that you understand what I think about in terms of where companies should look for capital at different stages, and then what those capital strategies are, who's got what today, how much capital is being deployed by whom, and what the industry benchmarks are. This is a very funny slide. That thing in the middle shouldn't be there. But if you could just look at the pink boxes, where I'm not sure why that's there, but apologize. Anyway, what we're going to talk about first is stages of companies, the tools that are used, and the players. We're all talking about seed stage companies here tonight. That's what we're focused on. And people who participate in that are using common stock, founders stock, grants, that sort of thing. That's what's going into those companies. The players are founders, family, friends, SBIR grants, universities, governments, and incubators. That's really what you guys are dealing with today. Once you go beyond that, you go to early stage companies. I wonder if I can actually wipe that out. Probably I shouldn't edit right now. That gets more advanced. The companies are larger, and that's really the stage at which angels, corporate venture capital, and really private equity using tuck-in acquisitions happens. So I heard a couple people say, go ahead.
Can you explain what tuck-in is? Do we know?
Tuck-in is when you're a private equity investor and you own a company, and you think, gosh, if I only had a company that had a mailbox light in it, then I will just buy that little company, even though it isn't big enough to be a standalone company, and it becomes a product as part of a larger product line.
It's a tuck-in?
So we tuck it into the product line. So you don't have to replicate management, you don't have to replicate overhead, you just expand the product line so they get a bigger company more quickly. What we're using here is, again, common preferred. This is where you get into convertible notes and things like that. This is so well established, though, at this stage. And the point that I'd like to make is, once you get to this phase, this early stage phase, you've really got something. It's before that, when you're at the seed and product stage, that piece of the market is massive, massive. There are so many ideas out there. People who can take it from seed to early stage, that's a big leap. And once you're there, you pretty well got something that ought to be able to drive you all the way to a company. But that first step is the biggest one. So going from early stage to Series A and B, the funnel's definitely narrowing, but it's where you're ramping sales. And I mean really ramping sales. This is where you're putting money in to make that happen. You're using preferred stock. You're doing joint ventures here, you're using mezzanine debt. Mezzanine debt is really just a different way of saying you're using senior bank debt here, you've got revenues, you're using venture capital. At this point is the first point at which we should even think about venture capital. You might get early stage venture capital as an early stage company, but it's so rare, it's hardly worth looking for. And I'm going to talk a little bit about how rare that is, and then you go on to Series C, and then the IPO and the M&A. All those are sort of wishful thinking if you can't take that first step from seed to early stage. Now I'm just going to put some numbers around those ideas. When you're in the seed and product development, Doug, is there like a clicker so I don't have to stand behind here? Do you know? You don't. I don't see one.
I can advance it for you.
No,
if
I can
you
do it.
prefer.
It's okay. Not a problem. Because, oh, wait, what's this thing?
I don't think that's going to do it for you.
No.
Not
Okay.
necessarily an advancer.
Yeah, I can advance it for you.
No, absolutely not. So when you're here at seed, I'm going to drill down on this a little bit. The seed stage, obviously there are no sales. No one's expecting sales at this point. Your EBITDA is negative. But the average value here in this stage, when it's just your idea, if a company is sort of thinking about trying to, how much am I worth? The value is between $1 and $5 million for a real justified seed stage company. That is not nothing for a product that's really in development still. And the average deal size in the seed stage category in 2015 was $5 million. Now, there are very few deals that happen in that phase, but that's how much the average was at that stage. Yes?
What was like a median on that?
I don't know. I'd have to go back and look at the statistics. I'll tell you where I got that number, though. I use a lot of research from the Angel Capital Association, and they look at these numbers pretty closely. So it was either from there or the National Venture Capital Association. Two places you can go look. And the next number, the 2%, that's something I just want to really highlight for you. Remember I said venture capital, not really at this stage. Only 2% of venture capital dollars, 2% go into that stage. But look what happens when you hit that early stage. Remember I said that was a big leap. This number is a really big change, right? Venture capitalists are starting here at sort of the end of this phase. They're saying, okay, I can participate here. But it's a very specific group of venture capital investors. It's the early stage. Remember I said there were different kinds. It's the early stage VCs that are participating here. And here you've got sales. You're dealing with product features. Your sales are 0 to 5 million. Still negative EBITDA. But people value companies in this phase at roughly 2 times projected sales, and that's future, like the next 12 months. So you've got some kind of visibility on your pipeline here, and the average deal size here was $8 million in 2015 in that phase. Series A and Series B, here you've got a real company, it's break even, it's kind of reinvesting every penny it has, it's still raising capital. Average deal size here was 18 million. But the big change here is that you go from projecting sales, because you don't really have any, and coming out with your valuation that way, to actually multiplying times your current sales. And that's how people in the Series A and Series B are being valued. It's a really important distinction in my world because companies often don't want to recognize that they are being held accountable for their own sales, because a lot of times they think, gosh, if I just grow my, keep my product developing, etc. I mean, at this point, people are really expecting you to have sales, and 37% of venture capital dollars are spent in that phase in 2015. Now, those numbers shift around dramatically year to year. We're in the middle of a cycle of kind of the later stage of the venture cycle right now. Like in 2014, this number was 56% in 2014. Yeah, because people were really at the earlier phase, and then it's just like it's like a snake swallowing a mouse. It just has to work its way through, so it's working its way through. When you get to Series C, only 27% of venture capital dollars are happening out there in 2015, kind of finishing out a lot of those early investments from 2013 and 2014. And here the valuation is done based on, really it's done on EBITDA. So here the company's making money, it's got cash flow, etc. And then finally, IPO. What I think is interesting about this transition is, these average deal sizes are cranking and cranking and cranking, but all of a sudden when you do an IPO, the IPOs in 2015, $122 million. That was the average. So the reason I went through this, a lot of this is probably obvious to you, but it's helpful to me to keep in mind these categories because people use them a lot. People use these words a lot, but it's so hard to really make those leaps from category to category. And the reason is there are really big characteristics that are different. Like, look at the EBITDA here. People are expecting you to be making money out here, but not until way out here. Here it's break even, negative. So, the investors have real process and they put themselves in these different buckets for very important reasons. It's like, who are their investors who are investing in them and what are their mandates? And all that is like in our investor discussions, we are having to get very granular with people, like, what percent? I have actually 7% allocated to this category. I have most of the rest of my funding is allocated to this category. I'd skip over early stage completely because that's how our fund is set up. It's perhaps irrational, but that's what our investors wanted. And it all has to do with their risk profiles, etc. So,
Liddy,
yeah.
It seems a lot of companies, especially in the digital media space, are managing to go IPO through a reverse merger with revenues of 1 million, 2 million. I know at least I've invested in one company with revenues of 1 million. They have a valuation of 100 million today. They did a reverse merger up in San Francisco. And I know so many others. I know another one that has 2 million in revenues. And I checked today on their pink sheets, they were 258 million, and there's a good value of trading. So it seems like that's another opportunity to do a reverse merger and a secondary offering.
It's a great way to go. Absolutely great way to go if you want to be in the public markets. A lot of companies find being in the public markets to be a really mixed blessing because, it's a lot of expense, a lot of exposure, but in terms of the way to get in, absolutely great. And that's, to your point, Steve, this is just generic. There are so many ways to skin this cat.
Just the fact that you're in process for a reverse merger and a listing gets everybody else to jump in.
Yep.
Before that,
Because you get liquidity. All of a sudden, bam, you
they're
got liquidity.
anticipating liquidity within 12 months, and they want to jump in now because they see you on the path.
John, didn't you do a reverse merger?
No, we did an IPO last
May.
Smaller than the one you described, actually. Yeah,
I see.
San Francisco-based company. Yeah, it's a small company being public is extremely difficult and expensive.
Who's the ticker symbol?
Or a Reg A.
JAGX. It's an animal health company.
And since the issue of pink sheets come up, you kind of give me PTSD from long ago. And I think as soon as the long bond moves 200 basis points, you're going to have the same.
Yeah, people are chasing yield now. So in this low interest rate environment, even the risk tolerance is higher for startups because there's too many other places to go for yield.
What else are you going to do?
Yeah.
Right. Okay, so and sort of along those lines, like, where is the money today? And essentially, someone said it's really a drag to use angel investors, but the fact is they're the biggest investors by far, just by far, although they're a real pain in the neck, really slow and very idiosyncratic and hard to really corral. But there's about $20 billion in 2015 that went from angel investors into seed stage companies and early stage companies. That's spread over that. Venture capital at about $600 million. Corporate venture capital, and someone was saying that they've got their product lined up with a huge corporation. I've forgotten who it was. You. Right. Perfect. That's corporate venture capital in a way. When corporate venture capital is about $3 billion in 2015. And then SBIR grants are $2.2 billion, the best money you can get. Cheap. But tough to get through because they know what they want and you have to adjust your product to their desires as opposed to the other way around. On the other hand, it's not bad to please a customer like the government. So that's kind of where the money is. And then there's crowdfunding. How many of you guys have done crowdfunding? I know, Doug, that was cool. There's a lot of crowdfunding going on today. And John, I know you know a lot about this, right? Because you actually ran a company that tried to do this. So I think crowdfunding is making a big difference. What do you guys think about it at this point? Crowdfunding.
Don't know enough.
Not enough?
I don't know enough about it. I never used it.
I wonder if any of the big names are doing equity crowdfunding. I'm not paying that much attention anymore. Where it's,
Cliff and Eco just came out with a book on it.
That's just
And
what's
I just
happening.
finished his book. I just finished reading it.
under the Jobs Act.
Yeah.
Title
Yeah,
III.
he called it crowdfunding, but it was really equity funding.
Yeah.
Yeah.
And it was not specialized in the kind of project crowdfunding that Kickstarter does. It was really specialized in the Jobs Act stuff.
Yeah, equity crowdfunding is only a year and a little bit old.
But we still have to do a Reg D. Okay.
Yeah, you have to have the documentation, but it's super simplified. It's like
Yeah, I think
completely
until
streamlined.
Indiegogo and Kickstarter, they have the base. So I think if they decide to jump in wholeheartedly,
I heard they're
there's
going to actually.
something there. But it's just hard to build the base. They already have it, which is great.
Yeah, but most
And
of
I've
the
read that,
customers.
that later stage investors won't touch the Jobs Act funded company because there's so many people, suddenly
Exactly.
inherit hundreds of people on your cap table.
And we actually tried to invest in one that had that background, and it was a nightmare. This woman, Shirley, was like, she became the nightmare that nobody even knew her. And it was like, who is Shirley? Shirley won't sell it. Well, then let's get rid of Shirley. And so the whole thing fell apart because of Shirley. And I was like so angry. But you just can't control the client base at that point, so it's very tricky.
What's the product base for that?
What's the what?
What is the product that you're just talking
That was an IT software company that had tried an early process for equity fundraising through a company called, I can't remember what, and they came to us for some early stage funding, and they needed, because of the way they had set their documents, they needed sign off from all of their investors, and they had like 58 investors, which is relatively small apparently for some of these funded companies. But even so, this woman thought she was going to get diluted. So I have to go back and look at the details. It was one of our pre-seed companies, but
So would you make all of them sign your shareholders agreement with your drag along rights?
wouldn't you think?
I would think so. If you got all these thousands of people, how do you do it logistically? When they're all over the world giving you small bits of money, how do you do it?
I don't know. There's got to be a way to document
Maybe
it
a digital
correctly so
signature.
you don't require signatures of everybody.
Blockchain.
Digital signature.
Yeah, I don't know. So since I told you that, I think still today, I think this will evolve. I think that the equity crowdfunding is going to be really important eventually. It's just not quite there yet. I'm going to focus your attention on angel investors. 80% of angel money is invested still within 50 miles of where the angels live. 80%. I was so shocked because when I started angel investing in 2004, that was the case. And I thought, that must have evolved. I don't follow it that close. So I was looking at the statistics, nothing's changed. People just want to invest locally. They want to be involved. That's the thing about angels. It's good and bad. Doug points out, can be great, can be not so great. Average deal size, though, is an interesting statistic to me. It's gone up a lot. In 2012, the average deal size was 1.8. Only 4 years ago, it's gone to 4.6 million. You might say, not the angels I know, they're such a pain in the neck, they're trying to dribble out $50,000 at a time and makes you crazy. What's happening is the bigger angel groups are, like I was down in Houston recently, and the Houston Angels they're putting together $1.5 million, $2 million every round, and then they're bringing in the guys from I don't know, other local angel groups, and they're putting in $4 million transactions all the time. Now that isn't their first time, and usually this is a company pretty well developed, but Angel rounds are getting a little bigger.
For an individual angel, what's the average amount of an investment in a given company?
So that has not really changed. People usually allocate less than 5% of their overall investable cash. And within that 5%, they usually want to have at least 20 investments. So that's what categorizes their allocation per company. So the average angel investor has a net worth of investable cash of about $10 million. And so you think about that, and so that's $500,000. You do that 20,000, 50,000 in that range per company. And then you spread that out over 20 companies. You're kind of in the right ballpark. So you're not too concentrated in any one company. Some people think 20 investments is too much. Maybe you want to go to 10, closer to 50,000. So it's in that range that the average angel is going to focus.
From the angel's perspective, how many of the investments that they make do they expect to get a positive return on?
Oh, I don't know what people expect. I don't know why people do angel investing. I've done it for years. It's stupid. It's just crazy. It's so much fun and it's so interesting. I mean, just sitting in this room tonight, listening to all of your ideas, I'm going crazy with excitement. So cool what you're doing. But in terms of a financial strategy, not so good. Not so good. You know? So it's a lot of people who are no longer working, no longer really care what happens to that $500,000 of their portfolio. As long as it provides interest, might do some good for the world. Often that's a big driver. I know a lot of angels, there's one angel in particular, who is just all about sepsis, finding a cure for sepsis. His wife died of sepsis. That man is going to cure the problem of sepsis. Or he's going to die first. He doesn't know which, and he doesn't care what happens first, because he's just hell-bent. So it's that kind of thing that drives a lot of angel investing, not so much about the returns, which can be good and bad. Now, there are some angels who are doing it professionally and really care about the return, and that can also help drive the company forward to a bottom line.
Do you think
Yeah, go ahead.
those two types of drivers, the guy whose wife died, that driven angel investor, versus the professional, is there statistics at who
What
does
you
better?
really want to know is there an address book for each one? Yeah, I don't know. I don't think there's any way to know. But I do know that actually Doug here is a member of our local angel group, the Angel Investor Forum.
So is Jason.
And Jason is too, I know. That's good. So I'm very pleased that you guys are involved there. Landmark Angels is another one down in Greenwich. Big difference between those two, and I just want to highlight, if you guys are thinking ever of going to an angel group, the Angel Investor Forum, and I take a little bit of responsibility / credit for this one. They don't make money on the companies that are coming to get money. Their theory is, if you need money, we don't want to charge you money to find out if you can get money. That doesn't really help you. And so Landmark Angels has a slightly different strategy, as do a number of other angel groups, where they charge you like $3,000 or $5,000 just to get in front of angel investors. When an angel group charges you, be careful, because they're not guaranteeing you any money out the other side. So I think the Angel Investor Forum is more the type of model that you want to look for. Although it's an active group, they actually have a little fund so that invests alongside the angels. New York Angels is another very active, very well-heeled group. But you find groups, kind of like the guy from sepsis cures. Groups have their own dynamics. New York Angels, Brian Cohen is kind of the leader there, and he was in advertising, and he is all about social media. He just loves that stuff. And so that group, you'll find, makes a lot of investments in that area. So you have to kind of learn and go, if you're interested, go on the Angel Capital Association website. Some angel groups are like just doing biotech, some are just doing software, some are just doing information technology. You'll see. And what you can't find out, you have to call somebody. But that website has a lot of information. So I'm just going to quickly crank through venture capital statistics because I almost think this is irrelevant for everyone in this room at this point. But eventually, it might be relevant, so I'll just give you some sense. Angel had about $20 billion last year invested. Venture last year had about $30 billion committed, meaning money going into funds, and $60 billion was invested. I told you we're kind of coming to a late stage of the cycle in venture right now, so there's a lot of money getting invested because they've raised it, now they're investing it, and it's getting a little unbalanced right now. 70% of venture money is going into information technology. 70%. So basically, if you aren't in information technology or biotech, that's the next round down, don't bother. That's what they're investing in. 40% of it, seed stage I mentioned already is 2% is in venture, it's in seed stage. California had 40% of the money, New York had 11% of the money, Massachusetts had 9% of the money. So those are the three big ones. They've been the three big ones for a long time. The average deal size in the in early stage here is only 5.4. So it's not that different from this is for I should have said average deal size for seed stage is not that different. So if you actually got a seed stage investment from venture capital, which is pretty rare, it might be about the same size deal as what you get from angels today. And very often they work together. In fact, the lines between the two are only distinct in that venture funds are investing other people's money and angels are investing their own money. That's kind of the big difference. Deal structures are very similar today. Here's a list of local early stage venture funds. It's a little longer list than there used to be. Launch Capital is really active. They're in New Haven, but they're also in a number of other cities around the country. Elm Street Ventures is strictly New Haven based. They do a lot of biotech. Vital Financial is up in Avon. Connecticut Innovations, you probably mostly heard of Connecticut Innovations. They're the biggest venture fund in Connecticut. They're in over 85% of the transactions that happen here in Connecticut. Basically, if you are not on their dance card, you are not going to dance in Connecticut. So, call them. Yale Ventures is kind of a new thing. It's just targeting people who are in some way affiliated with Yale. Ivy Ventures is just forming, and that's also targeting Yale related. UConn Ventures has just set up the same kind of thing. So there are a lot of little, seed stage funds, and then I mentioned already the Angel Investor Forum has a little fund. These are little funds. We're talking 6 million, 10 million, but going all for seed stage. Just to crank back for 1 second, why are some people going for seed stage? Even though I told you it was really crazy to do the angel investing, the fact is, if you look at the return curve, the returns are highest if you get in earliest. So that there's madness here, but there's also a method. Corporate venture capital, huge. It's the fastest growing area of venture capital today. Absolutely skyrocketing in terms of activity. Unbelievable. $28.5 billion. That was an absolute record. 10 years ago, corporate venture capital was a concept, and this has really just become a driver, and you know why, right? Many of you have probably spun out of big companies. It's because big companies don't do innovation at the same level that they used to, so they're counting on being able to buy it. And for you, as inventors, the way to take advantage of it is to find a company that has a strategic fit for what you're doing and connect with them. Connect early, find their venture capital arm, and use that connection and pitch them early. This is just a top 10 list. These are the top 10 most active corporate venture capital funds in the U.S. today. I'm sure you know almost every one of those names. And this is easy data to find. CB Insights is my resource here, but you just have to go on. Actually, it's interesting. Sometimes you can't go on their websites. Like GE has a big venture capital arm, and it's not listed on their website. It's completely different. So you sort of have to do a little digging to find some of them. And then the federal programs. This is like free money. This is so great. We already mentioned it. SBIRs. It's actually a pretty big program. In Connecticut, there is a whole team of people very experienced in SBIR. If you have a product that you think might fit into any of these categories, or you're thinking about developing a product, go to the SBIR website, go up to Rocky Hill to the Connecticut-sponsored, absolutely free for all to use staff and talk to them about what you need to do to get an SBIR grant. They will walk you through it. I mean, they will literally help you fill out the applications. It's a great resource. And if you get the money, it's a grant. I love grants. And then you go from the first, do you guys know how that program works?
Yes.
No? Some of you do some. So I'll just crank through it a little bit. There are 3 phases of the SBIR grants, and STTR is similar. So, but the SBIR is a much bigger program. Phase 1 is really developmental. So what happens is there are 15 branches of government, but there are really 8, and really there's one, the DoD, the Department of Defense. 50% of SBIR money is allocated to the Department of Defense. Surprise, surprise, it's where 50% of our budget is too. So it's a big number. The Department of Defense gets to make a wish list, things they wish existed that don't. And so then they put it on this website, and the website is kind of really specific about what they want. And then you, as an SBIR applicant, tell them how your thing, your product, your service fits with what they've said they want. And it's kind of usually a little bit of a negotiation as to whether it's an exact fit. It's not exact, but it's close enough. And then they kind of twist it, make it fit. Yeah.
How do you find out what they're looking for?
You go to the website.
No, there used to be financial business or something that they published a paper and they said these are the things we're interested in. But that was 30 years ago. What's it like now?
The website.
Website.
Just go to the website.
SBIR, SBIR World, SBIR Resources, SBIR. There's like 10 different ways you can get into it, and then you search. Like, let's say that you're developing a perimeter watchdog. Probably not what you call it, but let's call it that.
That's close enough.
Okay, and you say, that's what I've got. Who needs that? Probably the Department of Defense. And so you probably go there first as opposed to the NIH. So you kind of narrow your search that way, but it's a huge database, and it's a constantly rolling application process.
Since I'm retired, would it be worth my time to go up there? I used to work for the government, and the majority of your government workers throw your application, whatever you have, in the trash. Someone else will handle it, and it goes nowhere. So
That's not the way it's set up. Yeah.
No, this is data. You go on the website, you find out what they want, you find out what you've got, you see if they fit, and then you kind of go as far as you can, and then you call the people in Rocky Hill.
I'll give you some information.
Yeah, and they're really
afterwards.
good people.
Excellent.
Marie London runs
I've
it.
got a proposal out. I know how it works. I can
Yeah.
tell you. I'll tell him about it.
Yeah, tell them, because it's really worth it.
Actually, I was the winner of SBIR in the past. So if you want, I can share the reality of it. It's competitive. Basically, it's basically have the agencies ask what is the problem, they need a solution, and then the phase 1 basically just give them idea.
Right.
Then the
$100,000, $150,000,
$100,000.
and that's all you get. And you have to develop it from there to a product, an idea to a product with that money.
prototype.
Prototype, yeah.
Yeah, but half to 1 million. Then you commercialize it. Then that's unlimited. But then you get a called a sole sourcing situation. So for very like one of a kind technology,
that's what I have.
yeah. So you can get a sole sourcing situation.
Yeah.
So
that's phase 2 is like $750,000, and then phase 3 is the commercialization.
Yeah.
My firm invests in SBIR phase 3. So
Yeah.
at that point, it's already developed. It's already got a contract, usually with the government. So we know that we're just really funding their commercialization process.
Thank you very much.
Guys, keep in mind, when she says DOD, they're not just looking for bullets and helicopters. They need everything that we use in the private sector.
It's a massive.
It's
wish
they
list.
use everything, from medical to data analytics to everything. I know people who had a system of software that was designed to look at certain things out there, and then DARPA says, no, we can use that for our soldiers. They want to look for specific things, and it became a great fit, even though it's a piece of software. So don't say to yourself, they're probably looking for a gun or a bullet or a helmet. They need everything.
That's a good point. It's a really big
They
program.
tell you exactly what the problem is. They tell you exactly what it is, and wow, see me afterwards. I'll tell you about it. It's really cool.
It's one of the most important systems in the world, I think, for innovation, for funding true innovation. And you guys are all about innovation. So this is something, if you're in the inventor space, you need to think about this. $2.2 billion a year in that particular thing. So that's the federal. I want to talk about federal a little bit. Now this is Connecticut programs. I hear a lot about how bad Connecticut is in terms of business climate, and I am not here to refute or discuss that. What I can tell you is that my firm has 19 state-focused economic development programs in 19 different states, and Connecticut is by far the most aggressive state in terms of helping small businesses. And here are the programs that at least I'm aware of in Connecticut. The first is the Department of Economic and Community Development. They are allocating lots of money every year to big companies. We've all read about Bridgewater, if you're sitting here not far from Westport, and we've all read about the demise of the GE headquarters right here in Fairfield. But on the flip side, they're putting lots of money into little companies too. And it's a big help to little companies to get that kind of capital. So if you have an idea, you need to just apply for the express loans or express investments. What do they call it? I think it's express loans. They're grants and loans that they do through DECD, forgivable loans if you hire people, that kind of thing. Very, very helpful. And it's hundreds of millions of dollars a year that the DECD is allocating, so it's a lot. 1,600 companies have gotten funded in the last couple of years. It's a very broad-based program. The Angel Tax Credit allocates $3 million a year, so if you're a Connecticut company and you're getting an angel investment, you can get that tax credit back to your investors for 25% of what they've put into you, which means that they are a little more likely to invest. Invest CT, that's the program that my fund is part of. And I told you already I have to put 7%, I think, of my capital into early stage pre-seed, so that's $10.5 million that we're investing in early stage pre-seed companies over 3 years. And then CT Next is a piece of what used to be part of Connecticut Innovations, but it's for really early stage companies. In fact, just last week I was a judge for one of their programs where we gave out $50,000 in $10,000 chunks to 5 companies that were selected out of 41 applicants. So those odds are not bad. And those are all prototyping, all just trying to get their prototype to a point when where it's a product. Yeah.
I don't know if it's still a program, but a few years ago there were matching funds available. The mailbox might actually qualify for this particular matching fund, where if I found a manufacturer in Connecticut, they would put up half whatever the money was to, provided you employ at least one person, there was free money available for actually
Yep, that still
getting something
exists.
made in the state.
That's part of the DECD program.
That would be grant, or would that be all right?
It's matching fund, so it's given to you. It's grant money. You don't have to pay that back. They a certain amount for an intern, like $5,000 toward an intern, plus matching funds, whatever it costs to actually get the document. All this, of course, But whatever it costs you to actually make it in the state, they will equal that amount of money.
There are some other internship programs too that they still fund. So if you're looking for people to kind of help you with a piece of the product, you can look at those programs where they help.
Quick question on the angel tax credit, is that an application process?
One page.
From which organization?
It's actually
Google it
administered
first.
through Connecticut Innovations,
Oh, okay.
and it's on it's ConnecticutAngelTaxCredit.com, I think. There's the application, and then it goes through the Department of Revenue, because really the only part of the process that someone has to certify that there was an angel investment and that you qualify for the tax credit, but then the angel investors actually apply for the tax credit directly through the Department of Revenue. So you as an entrepreneur never have to actually get your hands involved.
It's probably capped each year, not by company.
$3
but
million is
overall
what the
pool.
cap
But
is.
that's per company, right?
No, that's the whole pool.
Oh, for the whole state?
Yeah.
Oh, so it's
Always oversubscribed.
I see.
We keep trying to get them to bump it up, but
Yeah.
it hasn't happened lately.
I think the companies have to apply.
Yeah.
To be eligible for
Well,
their
to get
investors
certified,
get
and
the
then they're
credit.
investors, exactly. That's what the application is. Yep. Okay, so those are some Connecticut resources. These are some obvious things. If you're thinking about turning one of your ideas into a business, make sure you pick the right business and make sure it's in a really fast-growing sector, and that you don't require a lot of capital, so it's capital light, and that it's a market that you can identify and access. So often it's hard to do those things. So in terms of value creation, you want to make sure there's a huge market need. These are the things that we kind of check. These are my checklist things. There's a really strong value proposition, really financially based value proposition. There's an experienced team, there's a clear financial plan, and there's some kind of barriers to entry. I was struck tonight by how many of you are involved in patents. And I will say that from our perspective, patents have lost a lot of luster. There's just no ability anymore to protect your patents, to defend your patents, unless you have some significant resources. It's a great thing to have. I'm not saying it's bad. It's just that they can be a real impediment for people going forward. And the costs involved in getting them can often be better applied to just developing the product, getting it out there. And so it's a double-edged sword, I understand, but I think there's a lot written about whether or not patents really make a lot of sense today for a lot of small companies. Because people used to think that there was a lot of value for patents, but if you look at the aftermarket for patent purchases, I mean, there are some people here in the state who actually used to make their living just reselling patents, and that market has just declined to zero, basically. Because as I said earlier, there are so many ideas out there. Ideas are often not the problem. The problem is turning them into a product that can actually be sold. Yeah.
So I went through the process of applying for a Connecticut Manufacturing Innovation Fund voucher, and I went into their program and I provided them with the letters of good standing from the Department of Labor and the Department of Revenue Services, and I wrote the budget and did all the stuff. Never heard back from them. So then I went up to CCAT and I said, hey guys, what goes on there? How come I don't get any feedback? I mean, it could be binary, like you got it or you didn't get it, or maybe even constructive, like why you didn't get it. But I got nothing. Am I supposed to hear from these people?
Yeah.
CCAT, I understand, they're over a year behind, and they're already gone through the funding.
I think they're just out of funding. I think that's
I
it.
applied too, and I've heard it takes up to a year and a half to be approved.
In my field, that is a stinking eternity.
I hear you.
My backers are not going to wait a year and a half for their for the rewards.
Yeah.
They want it like yesterday.
Yeah.
It can be a problem. I think a lot of these government programs sound really great, and they can take longer than you would want them to. Not all of them, but
I can tell you that
I can't tell you.
Peter Mulray of Guardbach down in Stanford said,
Yeah.
"Don't bother with those guys. It's a waste of time." And I'm of the opinion that I want to take everybody's feedback and I want to take it in and sort of maybe I'll listen to it, maybe I won't, but I decided to try anyway. He was right.
Well, can I just say that, like all processes, there are fast lanes and there are slow lanes. There are quick ways to do things and slow ways to do things. And sometimes it's knowing the right people.
What is CCAP?
Connecticut Center for Advanced Technology. If you've got someone who can walk you in that front door, talk to the right person, chances are you'll get heard.
I was just going to add to bolster your point about the value of patents. The case study is this particular mailbox light, which was infringed. A company in Massachusetts manufactured it. I tracked import sales, made over $20 million. Actually, at the time, I spoke with Donald Stout, who was one of the premier patent infringement attorneys. He took my call, was very gracious. He explained that it was going to be extremely difficult for me to take any action because even with $20 million in sales, if I got, say, 5% of that as the inventor, if they'd entered into an agreement with me, it would be $1 million. But the attorneys will only get $300,000 or $400,000 of that, and it can cost easily twice that much to prosecute the case. So the math just isn't there. And this is a guy, he won what was the largest settlement at the time. He won $700 or $800 million. And so this is an expert who told me, listen, I hear you, it sucks, but this is just the way it works out. There really isn't any feasible way to make the numbers work in this case.
That's exactly right.
Only caveat to that is if your product becomes a multi-billion-dollar product, then that same attorney will say,
I'll take it.
I'll take it. That's the only caveat to that. Because he's right. That's the only caveat. If it goes big, those attorneys will all line up to help you.
Which is why the last line in this presentation is go big. Because if you're not going big, you might as well not go. So what we look for, when someone applies for us for cash is, and John's sort of an expert on this, is giving us a financial model with details, giving us a cash flow that's pretty aggressive, because no one has ever come to my office and said, I want you to know that these are wildly optimistic numbers. No, they don't say that. They say this is a very conservative projection. It's just the way people are. Just don't be shy, because no one is shy. Potential versus risk. That's really what we're looking for. We want to know the upside, the downside, and then we're fine if you're wrong. It's what we expect. But we do want you to know what the comparables are, because nothing any of us will ever do is new. We all know that, right? So we just want to make sure that what other people have done, we've used enough to learn from. I am a huge supporter of people who come into my office and say, here are the other 10 guys who failed at this, but I'm going to do it differently, and here's why. At least they know what the failures are, so maybe they'll avoid some of those pitfalls. Another little pet peeve of ours is people coming into our office and telling us all about the science. I don't care about the science. In fact, I'm at the point now where I don't even let people tell me what their product is. I just want to know how much money I'm going to make on it. And if they tell me the projections, and they tell me what the market size is, and they tell me that they can access it, how they're going to access it, how they're going to sell it, I really don't need to know what it is. Because my judgment on what your products are is going to be so much weaker than your judgment. And I'll trust you to have come up with a product that makes sense for your specific field of expertise. It's not mine. Why should I pass judgment on that? What I know about is numbers, how to make money with a product. That's the first step. Now, I will want to know. In fact, I love knowing. I have to tell you, I just love this stuff. But I can't spend my time figuring it out. What I need to know is sort of, what's the deal? Tell me the deal. What's the history? Where's your current financials? Give me 2 years out and tell me how you've leveraged grants and other really cheap money to get there. So in summary, what we're looking for is a focus on revenue growth. In other words, I'm not at the product development stage usually, even though I do, it's called pre-seed. I want to know how that's going to get pretty fast. We don't like science experiments. We're looking to leverage grants as equity as much as possible at this stage. We're looking for strong value propositions. Now, when I say a strong value proposition, I want 50% improvement. That's the number I'm looking for. If it's less than 50% improvement over what the current product is, we don't usually see it catch on. So think about a few examples. Why did the Prius work, but all the other hybrids that had come before hadn't worked? Well, Prius went from an average miles per gallon of 25 to 50. All of a sudden, damn, that was enough for people to say, oh, that's a difference. But when it was 40, it was like, who cares? So I'm a Prius driver today because it was enough. 50% seems to be, we look, there are all these studies, like what is it that drives transitions? It's 50% faster, it's 50% cheaper, it's 50% more something, better in some other way. So 50%, keep that in mind. Targeting a large growing market. Now, Doug, I love what you do with that little box and the guitars, but as you said yourself, it's not probably a huge market. A lot of guitar
I'm looking
players.
at the guitar market now.
Yeah, a lot of guitar players. Now, is it growing? I don't know, maybe.
It's big.
Is it necessary? Is it, what's the value proposition there? I don't know. But maybe you do. And that would be what I would want to know, before I'd invest in something like that, is how do we get a market that's really going to make a difference? And I say big, when I say big, it's $1 billion already. Because to capture 1% of that is just a company that can be sold. Because we invest in companies to sell companies, not to hold them forever. And then make sure that when you figure out who your partner is, whether it's a corporate venture capital person or an angel investor, or a venture capitalist, or you go to the crowdfunding sites, make sure whoever it is has enough capital to take you all the way to wherever you need to go. And if they can't, then make sure you've got a plan and everybody's on board that you're going to get there. Because it's really painful to get halfway there. And then, I told you this is my last line. It's like, please, do something big. If you're going to do something, do it big, because otherwise it can be very, very a lot of money and time and not get where you need to go. So and then I have a list of websites that are useful. There's mine up top, Angel Capital Association, National Venture Capital Association, and then the crowdfunding sites, which are too numerous to name, and then here's my contact information.
Will you go back
Can
to
we
that
get an
last?
email? Oh, can we get that email or no?
Yeah.
Oh,
We're
awesome.
gonna, Doug and I are gonna have to work out. I've got a compliance problem where I can't make this public, but I will give to Doug what we can. Great. So that's my. If there are any other questions, I'll be around for a little while.